Thanks for clicking! The Bank of Canada is warning policymakers against tinkering with mortgage rules to make housing more affordable. This according to a recent speech given by Deputy Governor of the Bank of Canada, Carolyn.
Well, you should know. You made a living of it.
Yeah, the message is a little rich coming from a central bank that pushed mortgage rates down to near zero during the pandemic, enabling the housing market to blow up to such an extent that large swaths of the population can no longer afford to purchase.
We made that happen.
No, you didn't. Regardless, though, the warnings from the Bank of Canada come amid new mortgage rules coming down from Ottawa that we've discussed so much on this channel. First, the 30-year amortization for first-time homebuyers, and second, an increase to the cap for insured mortgages up to $1.5 million. So what I want to do today is go over the Deputy Governor's speech, take a look at the fireside chat she held shortly thereafter where she discussed the elephant in the room, the election of President Donald Trump to the south, and then discuss some implications. As we'll see today, that elephant in the room is going to be an ongoing issue for the Bank of Canada as it adjusts its policies to compensate for those coming out of the United States, and we will obviously continue to track any changes from the Bank of Canada on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into the speech. On to the speech. First off, a brief point of clarification as there have been some misunderstandings as of late. About a month ago, we covered on this channel Royal LePage CEO Phil Soper making an appearance on Bloomberg, where he said that the renewal wave was just about finished, would be finished up by the end of 2024, and shouldn't be considered when looking at the 2025 housing market.
We're over halfway, considerably over halfway. We'll be 3/4 of mortgages written during those pandemic lows will have rolled into post-pandemic rates by the end of 24.
The interviewer on Bloomberg didn't say a thing, no rebuttal, no fact check, nothing at all, so I did on this channel, making the point that that was asinine. And it looks as though the Deputy Governor agrees.
More than 4 million mortgages, or about 60% of outstanding mortgages in Canada, will renew in the next 2 years. And a big portion of these haven't renewed since rates started to go up in 2022.
So, just so we're clear, on the one hand, we have Phil Soper, CEO of Royal LePage on Bloomberg, saying something absolutely ridiculous, not fact-checked by Bloomberg itself, nothing new there. And then, on the other hand, we have the Deputy Governor of the Central Bank.
For you, one for you, and one for you.
But I digress. On to the meat of the speech. The Deputy Governor warning against tinkering with the mortgage market vis-a-vis 30-year amortizations.
There is no free lunch. Steps to reduce the short-term cost of mortgages for borrowers can increase the long-term costs. A quick calculation using current interest rates and the average mortgage size in Canada will show you that a borrower who stretches their amortization from 25 to 30 years will reduce their payment by $200 a month. But they will also pay an additional $50,000 in interest cost over the life of their loan.
Yeah, and they're not just risky for borrowers, they're risky for lenders too.
And while longer amortizations and smaller down payments will increase returns for lenders, they'll also increase risk for both the lender and the borrower because they reduce a buffer that can be used if a borrower runs into stress.
But, so what? Why do we care? Why do we care if a borrower and a lender want to take on more risk? Well, says the Deputy Governor, that risk ends up being passed on to the rest of us.
Regulators will adjust to this stress by expecting more capital, and investors may adjust by expecting higher returns. This increases the cost for lenders, and that cost often gets passed on to the borrower in the form of higher interest rates.
Listen, need a big favor.
So, yeah, the Bank of Canada, the Deputy Governor, echoing what we've talked about so much on this channel, the increased risk brought on by these 30-year amortizations, both for the borrower and for the lender as well. And, even more importantly, and even more telling, I think, we have, right there, clear as day, the central bank calling out the fiscal authorities, calling out Prime Minister Justin Trudeau for the introduction of these 30-year amortizations. Very, very strange to see coming from a central bank. As we covered on this channel, Governor Macklem told the Senate Finance Committee last week that with inflation back below 2%, he no longer has to scold fiscal authorities for deficit spending, but apparently he still has more scolding to do.
There's more where that came from!
Now, obviously the big question is why the central bank chose to do this publicly. something isn't quite right here, as it's very unlikely for them to proactively come out against a government policy. The bank doesn't just speak up without an underlying motivation.
Yes, they do. Yes, they do.
My guess is that the bank's motivation was twofold. First, the bank wanted the government to know that it will speak up if the government tries any more affordability measures. And second, and related, to let the government know to stay off of the bank's turf.
It's mine now.
Yeah, if the housing market is going to be the conduit through which the Bank of Canada conducts its monetary policy, then it doesn't want the fiscal authorities messing around in its business.
And I don't want you and another bird f***ing it up.
As mentioned, if borrowers take out 30-year amortizations, that means at the end of 5 years, they will have less equity in their home. Therefore, if the Bank of Canada is trying to stimulate borrowing, stimulate spending by lowering interest rates, those borrowers will be limited in their ability to refinance their mortgage, limited in their ability to borrow against their homes and go out and spend, stimulating the economy. Again, this is all just speculation, but my guess is the central bank has other reasons for doing this so publicly rather than just warning Canadians.
I don't want to see you get hurt.
And yeah, of course, as we've discussed before on this channel, the central bank isn't wrong in this regard. These new 30-year amortizations, A, as the central bank says, are more risky for both the borrower and the lender, and B, and almost even more importantly, probably won't achieve their desired results of making housing more affordable. What they will do, as we've discussed before, is enable buyers to bid up prices to the point where they reach a measure of affordability that we had back when we had 25-year amortizations. So, increased risk in the same amount of affordability as we had prior.
Wow, where do I sign?
So, that's the one part of the Deputy Governor's appearance, ironic as it was hypocritical, correct though it may have been. In the other part, the Governor engaged in a fireside chat where she was asked about the elephant in the room. The election of former President Donald Trump, or I guess current President-elect Donald Trump.
Let's talk politics.
Yeah.
I mean,
Central bankers are allergic to politics.
I know, but no one expected a definitive response, I think, as quickly as we saw.
Yes.
So, what can you share with us?
Which, of course, she wasn't going to answer, and then, of course, did not answer.
I think the Bank of Canada is doing what everybody's doing this morning, is sort of absorbing what we're seeing and the decision, and starting to think ahead to what it means. I mean,
However, later on in the speech, the Deputy Governor was asked which data points the Bank of Canada looks to when deciding whether or not to cut rates, and said the following.
We're looking at jobs data. And then, of course, you know, we're looking at what's going on in the world around us.
Right. What do you look at?
Well, you know, I'm pretty sure everyone at the bank was up late last night watching
Okay,
TV.
fair enough, fair enough. Okay, fair enough. Yeah.
And I think we can glean a little bit from this answer, as the Bank of Canada is very cognizant about what the changes down south could mean for monetary policy up here in Canada. Let's take a quick look at the bond market, which has seen Treasury yields shoot right up since the election was announced early yesterday morning, as the markets believe that the policies of President Trump will be more inflationary. Bond investors fear inflation only second to not getting their money back, as inflation erodes the buying power, erodes the return of those bonds. Now, if you believe that the Bank of Canada is lowering interest rates to target the housing market, as many, including Carl Shimada of Corpay, argues they are, then these higher yields are going to be a problem for the Bank of Canada, as higher bond yields in the United States mean higher mortgage rates here. Meaning, if Canadians have higher fixed rates than the Bank of Canada wants them to, then it's going to be more difficult to get Canadians to borrow and spend to spur economic growth.
I'm on it.
As such, if fixed rates are going to be relatively higher, then the central bank may have to cut short-term rates, the rates that the central bank does control, variable rates. It may have to cut those rates even further in order to induce Canadians to borrow and spend.
Always smart.
Which, of course, at that point, the trap should be obvious. Maybe not an intentional trap, but a potential trap nonetheless. If the Bank of Canada has to lower its policy rate to such an extent to get borrowers to borrow, to get borrowers to take a variable rate mortgage, take that variable rate mortgage at that lower rate, not available in the fixed market, because the US has higher inflation. Meanwhile, that higher inflation occurring in the United States eventually makes its way into Canada. then those holders of those variable rate mortgages could find themselves with higher borrowing costs when the bank eventually has to jack rates back up again to deal with that imported inflation.
That will never happen.
Now, obviously, I'm not saying to any 2025 buyer to not go out and take a variable rate mortgage. But what I am saying, and what those with variable rate mortgages should have been told in 2021, is to keep a close eye on what's going on in the bond market. Keep a close eye on what's going on with the central bank and what's going on in the United States. As we've discussed so many times on this channel over the previous few years, and as we're seeing right now in real time, what happens in the United States affects us far, far more than a simple rate decision coming from the Bank of Canada. So, the Bank of Canada scheduling and giving a speech where it gives the Prime Minister and the fiscal authorities a scolding on tinkering with the mortgage market in a almost sure to be failed attempt to make housing more affordable. Meanwhile, of course, the Deputy Governor isn't going to say anything directly about the election of former President Donald Trump, but obviously it is going to be weighing on the central bank's mind. And they're not wrong. The newly elected president promised major changes going forward, major outward changes going forward, and I think it's a good idea that we all remain cognizant as to how these changes could impact us here in Canada. We will obviously continue to track any changes coming out of the United States and how they're dealt with by the central bank on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.